Okay, so moving along, coming up next at 1:30, they're gonna go right up to 2 o'clock, is our Opportunity Zone funds. Multiply your returns with Opportunity Zone funds. And we have Michael, who's going to be moderating this panel. Michael, are you on the line with us? Michael, are you on the
Okay,
line
I
with
thought I
us?
was, I am. I'm unmuted by the host now. Can you hear me okay?
Yes, it's perfect.
Excellent. Yeah, good afternoon, everyone. Okay, so Michael, we ready to get started? Should we get right into it?
Yes, I'm turning it over to you.
Okay. Good afternoon, everyone. This is Mike Donofrio. I'm with ETS, Engineered Tax Services. I have an excellent lineup of guests with me today. I'm going to introduce the panelists, and we're going to kind of get up and through the newest and greatest strategies with Opportunity Zone funds, related investments, how it's impacted and enhanced with CARES Act, and what are some of the strategy challenges and opportunities around COVID and the virus situations around the country. I got an excellent group with Lane and Eric and Jason and Russ. Just a bit about myself as we get started. Again, this is Mike Donofrio. I'm Managing Director with ETS, Engineered Tax Services, based in Palm Beach, Florida. But I'm my home base where I'm at today is in Charlotte, North Carolina. I work with our team all across the country. This is the typical stuff that we work on as a specialty tax and engineering firm, really maximizing all federal, state, local incentives, credits, rebates, et cetera. Lots and lots of cost segregation studies to maximize that bonus depreciation. We're looking at all improvements and renovation and value add situations to get the additional credits that are there that most people forget about. The energy tax credits and incentives, if someone's putting in new lights or HVAC or roof or windows, even solar and other renewable energy projects outside the buildings, we're specialists there, so we can help. Construction tax planning, which is very important for opportunity zones, as someone is, planning a project or planning a renovation, start proactively. Some massive tax benefits there, as well as insurance and property tax and other things we can do. And then, of course, the CARES Act and other tax reform things that have come along, which I think have really helped. Opportunity zones were in there in the original CARES Act and Tax Cuts and Jobs Act. So opportunity zones were right in our wheelhouse of what we were already doing as a specialty tax and credit firm, working with historic tax credits, et cetera. So that's a little bit about us and what we do. So if we can be helpful, that's why I was asked to moderate this panel. We have extreme experience in opportunity zones, and I'm working on specific projects with folks on this panel, like Lane, since we get to the Lane slide. So Lane, I guess you're first up. I see your slide. Would you like to say hello and give the overview on yourself?
Sure. Can you hear me okay?
Yes, I can.
Great. We are an Opportunity Zone fund in the Portland, Oregon area, which has been rated out of the 8,000 opportunity zones, the top 10 by Fundrise, and there's other top reasons for it. We are a multi-family focused Opportunity Zone fund with an original use asset. Original use meaning that it gets bonus depreciation immediately upon the start of the fund. And we are using a combination of those strategies that you mentioned, like bonus depreciation, the Opportunity Zone benefits, and the CARES Act, to generate for some lucky individuals up to 101% tax savings in year one. And then holding the asset for 10 years, they can sell it for no capital gains tax. So this is an opportunity to multiply their returns, investors' returns, And we have a pipeline of additional projects that will deliver depreciation over the course of the next several years that will exceed the amount of the investment. So we look forward to telling you more about it and to hearing from the rest of the panelists.
Awesome. Thanks, Lane. And I'm going to get back to you on some of those CARES Act enhancements of things that change from a tax perspective as it applies to your projects and others. Eric, what you got going on there?
Thanks, Michael. Hi, everyone. This is Eric Herman, Chief Investment Officer at Life Afar. Our group has two primary arms to it, one of which being a boutique real estate investment and development firm. And on the other end, we have a hospitality operator that manages the projects that we enact in. We operate in Latin America, Caribbean, and now in Europe. And we invest primarily in hospitality, mixed use, multifamily, within those sectors, boutique hotels and luxury residential. The luxury residential products are optimized for short-term rental yields. So there is a hospitality aspect to it where we put together turnkey development products and then sell those off to investors and then return rental yields over the years. The strategy that we undertake with our equity investments is that of value add and opportunistic. We do also have a distressed asset acquired in the portfolio. So we look for prime located assets which we can redevelop or reposition and then generate high potential cash flows from. And if you're wondering what I'm doing here on an opportunity zone panel, excuse me, because we run two qualified opportunity funds here in Puerto Rico, both of which are single asset QOFs, and we're currently syndicating for the second fund. And so looking forward to a productive discussion today.
Yeah, thanks, Eric. Yeah, and great point on Puerto Rico. Most folks don't realize there's some awesome opportunity there as well as some other benefits, which we'll talk about in a second. Jason, how you doing? Good afternoon.
Good afternoon, Michael. Doing fantastic, and thanks to the organization for certainly having us on here today and being with all the panelists. Appreciate the invitation. Jason Cross, Vice President, Investor Relations for Red Brick LMD. We are investors, developers, managers in real estate operating in DC proper. We've got a barbell approach to our business. Got a couple thousand multifamily cash flowing apartments, and then a robust development pipeline, about 4 million square foot development pipeline in DC on Metro. We're one of the largest private landowners in the city, and we're actually the largest private opportunity zone landowner and developer in DC proper. And certainly excited about being on the ground, being able to bring economic development and impact to communities that have been starved of activation for years. And at the same time, being able to partner up with family offices, helping them fulfill their impact goals, and certainly bringing attractive returns to the market, and folding in the long-term tax strategies that are associated with opportunity zone development. And certainly excited about today's conversation. We've launched our first fund that we successfully closed out last year, and just launched Fund 2 in March. So again, thanks for the invitation. Excited about the conversation.
Okay, thanks, Jason, and look forward to learning more. Go to the next slide. Russ, good afternoon. Our workforce housing specialist. What you got going on there at Alliance Strategic?
Good afternoon, Mike. Thanks for hosting or for moderating this conference, and thanks to Michael Corselli for putting together this conference. We're grateful to be part of it. Alliance Strategic is a national firm with a long history in affordable and workforce housing, as you mentioned, all multifamily housing. The senior leadership team averages over 20 years plus of experience in that space. We've been responsible for the development of well over 100,000 units in 47 states, as well as DC and Puerto Rico over the courses of our careers. And we continue to focus in our Opportunity Zone initiative, which is in the early stages of raising funds on workforce housing, because we think that is the deepest and broadest need for multifamily housing in this country. And we think it fits very well within our broader experience over the course of our careers. So look forward to diving into this deeper.
Excellent. Thanks, Russ. All right, we're going to jump back to Lane. And Lane, I'm going to give an opening comment about tax policy changes in the CARES Act. Then I want you to dig in a little bit deeper as how it applies to your projects there, and then maybe some comments from the others as well as we jump back through. But I know that the CARES Act delivered some amazing just overall tax strategies that folks aren't, everyone may not be familiar with. You know, we still got that 100% bonus depreciation, which applies to purchases of existing buildings, and of course the new construction and renovations as well. But they also put in there two important provisions which might impact many opportunity zone projects: the increased loss limitations, as well as the potential 5-year carryback of those losses, so that you can go back. If we did a project in 2020, we can go 19, 18, 17, 16, 15 with potential carryback. How does that apply to your projects, Lane? And what are you seeing as potential benefits there for investors with those changes?
Well, the CARES Act has really changed the environment because it's essentially making a planned 10-year investment give as much as 15 years of returns, because by going back 5 years and recapturing the tax payments, they can multiply their returns. And when anyone makes money, they're always worried about paying taxes. Even if they got the money sitting in the bank, I don't know why it is. People worry about paying taxes because they just don't want to pay them. And one of the strategies that the opportunity zones allows is the decoupling of 1231 property gains from losses. So if you get to the end of a year and you've got a big gain and you've got a big loss, you marry the two together and you end up paying no taxes. We're all familiar with this strategy. But with the Opportunity Zone Fund investment, that Opportunity Zone investment takes away the gain and it turns the loss into a potential carryback loss that could go back for 5 years. So 2020 is going to be the most important year for people to work on liquidity and recapturing losses going back to 2015. So the CARES Act has been the opener of an opportunity to multiply people's returns.
Excellent. Jason, any impact from a tax perspective on your projects? What are you seeing out there and hearing from your investors?
Oh, certainly. And just seeing the sell-off from March, we've got groups that had been certainly supportive of the Opportunity Zone strategy and had been looking, and then others that, because of COVID, had seen, sell-off of some of their assets, and were certainly now not looking at maybe 3 or 5x gains or 8x gains, but maybe they still have 3 and 5x gains and are still looking for treatment on a favorable tax basis. So, we're having those discussions, and certainly Treasury giving some extra time for certain transactions that have been realized has been helpful. So that certainly has been a benefit. And one other item, certainly to add there from a tax perspective is just the fact that depreciation and that there's no recapture, which, for those in real estate has just been, it's like tax magic, as our managing partner, Louis Dubin, likes to always say. So that's been a powerful combination, and we've certainly seen interest post-COVID.
Excellent. Yeah, we have some projects we're working on in Virginia, DC, and Maryland area right now. Anything you're seeing in terms of specific geography or asset class while you and I are still on that point of your area of the country?
Yeah, for sure. And certainly, flight to quality is a consistent theme. As we know, even before current events, not all opportunity zones were created equal. Now, even more so, post-COVID, we're seeing flight to quality. Some of the top tier cities are certainly of interest. Certainly in DC, we like our positioning with the federal presence and just lessons from 2008, which we may get into here. But we're certainly seeing build to core as a strategy and a theme that is getting a lot of traction. Lower leverage is certainly just a culture and a theme that as a firm, Red Brick LMD, that we've embraced. And certainly just, quality of sponsorship is now, even more important. I mean, obviously everything begins with the who, but those are some of the themes that we're seeing in our conversations with LPs and other family office groups.
Excellent. Russ, I got a question for you. Speaking of themes, I keep hearing from different cities and municipalities that there's always the need for workforce housing. And it's hard to develop and finance that at times, as opposed to some others, because you have to deliver a return for the investors. But why do you guys focus on workforce housing rather than the obvious, building the Class A?
No, it's a great question, Mike. And first of all, it's part of what we've done for well over 20 years, affordable and workforce housing. And let me put a finer point on that. In the affordable space, a number of the properties that we have financed, invested in, built, and operated have some rent restrictions in place that go with the property, and that there may be some subsidies that come along with that, or as you're familiar with, low-income housing tax credits that help to finance those properties. And so we've done an extensive amount of those. Workforce, we tend to define as something that doesn't have any sort of subsidy. It doesn't have any sort of rent restriction. And you're right, the challenge has been, how do you build something that's good quality, that adds value to a community and is attractive to residents who would like to rent from you, and at the same time deliver the returns that we and our investors expect. And that's really, I think, the magic that comes from the opportunity zone incentive that allows us to broaden our footprint and to do more of that type of construction. And the reason we like it so much is we really believe that fully 70% or more of the pool of multifamily renters are renters by necessity. They're in that affordable and workforce housing space. Most all new construction, as you know, in multifamily over the last number of years, because of costs of materials, land, and labor, has been at the very high end of the rental market, and it's just been unattainable for 70% of the renters. So we believe if we can build or rehabilitate really good quality product and operate it efficiently, which we've been doing for 25 years, that we can tap into the deepest part of the renter market, and that we can return very attractive yields to our investors and our principals.
Excellent. I mean, I know it's a massive need there for our typical hardworking police officers, firefighters, teachers, folks that need that the housing in that price range. So thank you, Eric. Question for you. I'm in the tax business, so I'm asking some leading questions here, and I'm also working on some projects in the Caribbean and St. Thomas and USVI. But tell us about Puerto Rico. How did you guys end up with? I hear multiple hotel projects there, and why do they qualify for opportunity zones?
Yeah, so we kind of a bit of right time, right place. We started our exploration of the market here back in 2016, so prior to the enactment of the Tax Cuts and Jobs Act. And we were in the hospitality business. That's our bread and butter, hotel real estate and multifamily. And when we entered our first acquisition in Q3 of 2018, we underwrote the deal really absent of any consideration of tax credits or upside opportunity zone benefits. We consider that kind of icing on the cake. But the entire island virtually, aside from a small few pockets that are excluded, is a designated opportunity zone. And so the opportunity that presents to us, no pun intended, is geographically there's assets in locations that we would consider A+ prime assets compared to places in the US where it's not so much. So you have, our first hotel project is a boutique 60-key hotel in Old San Juan, which is a UNESCO heritage site. We have a beachfront luxury resort that we just launched for the second syndicated project. And so it's a destination with high tourism demand. And that's not something that you'll, I think, commonly find across the continental U.S.
Excellent. Yeah, and I can tell you personally, I'm looking forward to getting out on vacation and heading down to Puerto Rico. So I'd love to check out some of those locations. Lane, I'm going to jump back to you with a question a little bit more tax oriented. Tell us about how your projects and opportunity zones overall might differ in different tax situations for individuals. You know, the active versus the passive and the ordinary income earner. What are you educating out there in terms of opportunity zones for your projects and investors?
Well, that's a great question in terms of why would someone be interested in an opportunity zone? And an opportunity zone investment can potentially defer the tax for an ordinary gain. Let's say they're selling stocks in the stock market, or a long-term gain, or even a property gain. And the difference between an active or passive can make the difference of whether or not you can take it back 5 years and capture some of those tax payments that occurred up to going back to 2015. So typically what we see is that people will say, hey, I want to avoid paying tax on the money that's coming out of the stock market. And if they're paying an ordinary tax rate, in our state at the top level, it's 50%. So if they put money into a opportunity zone fund and defer that, they would save 50%, and their balance sheet would look a lot larger because of that. They'd have an asset worth the amount that they just put into the stock market, and then their deferred taxes doesn't have to be paid until 2027. Now it gets even better for somebody that has a property that they have sold and they have an offsetting loss. If they invest that property into an opportunity zone fund, then they can take that loss back and it becomes an ordinary loss. So if you have a loss that is being used against your gain, let's say you sell a long-term asset and you're going to pay a 30% or 33% tax rate. Well, if you invest in an opportunity zone fund like the Portland Opportunity Zone Fund we have, then that deferral of all those taxes, that deferral gets rid of the income that would offset the gain. So then the gain becomes an ordinary gain that can go back in time. So you're essentially multiplying the value of your deductions. So if a person has capital gains from short-term or long-term sale of stocks, art, whatever it is, personal items, or real estate, maybe you've even thought of doing a 1031 exchange. This is another situation where people that are doing a 1031 exchange are usually avoiding the tax by rolling over the entire amount of the investment. But if they're rolling into a opportunity zone fund instead, they only have to take their gain. So any of the other money that's available could go into their pocket and increase their liquidity. Then they get a completely new depreciation schedule when they go into the opportunity zone. So the opportunity zone fund gives them a pass-through of depreciation that can often exceed what they'd see in their 1031 exchange. And then over the next 10 years or even 27.5 years, they could be receiving additional depreciation based on the asset that they purchased. So those are the basics of the different types of investments, and we do our best at Portland Opportunity Zone Fund to provide insights on how to take advantage of those opportunities. Back to you.
Awesome. Jason, I have a couple statements and a news release that actually I just got sent to me, which I'd like you to follow up on from an investment point of view. But we're on the Real Estate Roundtable, and I just saw some notes from Ryan McCormick, if anyone's familiar with the Real Estate Roundtable, of what other legislation they're potentially working on to bolster opportunity zones. This is brand new information for me, and hopefully for you guys, this is really good news. I'm seeing that they're looking to add legislation right now to allow opportunity zone funds to raise capital from any source, not just deferred capital gain, which is potentially huge, and to and to change the current required 100% improvement requirement. If you're buying an existing property, you have to improve that property by 100% of the building basis, to qualify for the substantial improvement requirement, to dial that back to a 50% increase in basis. So those two potential changes that they're requesting looks very positive if they go through for opportunity zones. So I thought, and I'll send that around to you all and add it to my presentation so everybody has this information that I'm just getting. But regarding investment climate, how's it going out there? Are projects actually getting funded? What are you seeing with your investors?
Yeah, I mean, projects are definitely getting funded, and thanks for sharing that late breaking information. It's been quite an evolution of OZ legislation, and it was great being a part of the roundtable that created the white paper that then turned into the law. So we've been at this for some years now, and we can recall when the land was taken out, and some of those tests were relaxed, and certainly those would be game changers if there was additional dollars that could flow into this strategy. But we've actually seen the climate really improve, even just since COVID-19 had the impact on the markets. I mean, there was certainly a couple of weeks there of some disruption, but shortly thereafter, we've been conducting multiple closings, both at the fund level, and we've been accommodating investors at the QASB level as well for some of those investors that have already stood up their own funds. And one of the things that we're seeing is conversations saying, "Hey, look, I've got 60 days, 90 days to be able to deploy," and we're also seeing interest from an impact standpoint, where millennial kids of successful families are saying, what are we doing to impact these neighborhoods? What are we doing from a green or sustainability standpoint? So what we're seeing is that the opportunity zone legislation and then the resulting projects, and in our case, being able to be in the path of growth in DC, where we've actually got height limitations, which create less density, and certainly kind of post-COVID right now, we're talking about open green spaces, emphasis on walkability, being able to live, work, play where you live. So that multifamily execution, the office deals that we have that are already pre-leased, those are front and center and of interest in this climate. So we've been conducting closings, and certainly right now also there's been a downward pressure on both financing costs as well as construction costs. So from a pro forma standpoint, when you look out 10 years, it's actually a benefit.
Got it. And Russ, I'd like you to follow that up a little bit. Jason made that comment about impact investors, and I think obviously workforce housing and your mission fits right in the right in that realm as an impact investment for delivering those types of units for the community. What are you seeing out there in terms of investment climate? What's happening currently, and what about future acquisitions for the portfolio?
Thanks for the question. I think in terms of, first of all, you mentioned some of the potential legislative changes. I mean, we've had a significant role in advocating for some of those changes and an expansion to the investor market, in particular, working to try and encourage the government to give Community Reinvestment Act credit to financial institutions for making these types of investments. It sort of fits with the mission that many of them follow, to invest in the communities where they do business, and we think it would be further accretive to this space. As Jason said, the investment market has been fairly steady. We made our first investment as an organization 13 months ago on a new construction deal in Florida. That one's coming to completion within the next 60 days. We have a pipeline of deals that are ready to go now, all multifamily workforce housing, several of them in California, Southern and Northern California, deal in DC, and as Jason said, I mean, we think that market is a great market, and especially for workforce housing, where we expect that there will be significant turnover in the federal workforce, perhaps as much as 50% over the next 5 to 10 years. There'll be a lot of folks coming to work there. Our housing fits exactly what they're looking for in terms of good quality, affordable housing on a transit line, on a metro line, with access to employment opportunities. We've got a deal in North Carolina, which is an existing deal. We're converting an old bank building into multifamily. It not only has opportunity zone benefits, but it has historic tax credits that go along with it. We've got projects in the pipeline in Dallas and elsewhere. So the pipeline is robust. We're seeing a lot of activity and interest from investors, and really having, I think, pretty fruitful discussions with a lot of folks about that. And I think that the possible legislation out there to expand the investor base is only beneficial to all of us, because it will ensure that more of this type of project, more of these types of projects get done. And, you know, we tell investors all the time that what we're doing is impactful in a community that has a catalytic effect on community growth. It's the opportunity to make an investment and do well and do good at the same time. And that seems to resonate with folks.
Great. I see a question that came in, so I'm just going to throw it out to the group. I'm going to answer some of it. It says, it looks like it's from a John in Philadelphia. It says, can you take advantage of CARES Act's new 5-year NOL and depreciation look back or carry back inside of a qualified opportunity zone structure? I'm going to give my answer to that and ask Lane to follow up. I believe the answer is yes, given any specific projects, you know, basis limitations, you know, kind of like a 1031 exchange. You know, there are some basis limitations in the new project for the opportunity zone project, but all the new improvements, all the renovations, any debt or leverage that gets put on that project, John, the answer to that question would be yes, absolutely. Especially for the active real estate professional, for tax purposes, they could immediately potentially carry back that loss. Lane, any question, any additional answer you'd like to give on that 5-year carry back? I think that changes everybody's opportunities.
Sure. So I'm just responding to the basis. When investing in an opportunity zone fund, the basis comes from the debt. It's typically through qualified non-recourse financing. So the construction debt wouldn't normally qualify as basis because it has to be guaranteed, and typically the sponsor is guaranteeing that. With the Opportunity Zone Portland project, we have the qualified non-recourse financing in place. So the investor receives the pass-through pari passu with all of the other investors, and it's a 100% pass-through fund. So there's a possibility of receiving right up front a depreciation allowance that's typically 25% of an asset. So if someone was to cost segregate, Mike, you know all about that, the 5 and 15-year property, it's 25% is a good rule of thumb. So if they buy a $30 million asset, there's going to be $7.5 or $8 million of depreciation pass through. And in this case, if there's an investment in the Opportunity Zone Fund Portland, we expect about 25% of that investment to come through as depreciation. And then over the course of the next 3 years, through the completion of projects in our pipeline, additional depreciation will be distributed through the K1 that should exceed the investment amount in the Opportunity Zone Fund. So a first year tax savings for someone with 1231 property could exceed 100%. By year 3, the tax savings could exceed 150%. It's truly amazing. Depending on your tax situation, et cetera, you need to talk to your tax consultant and your attorney, and we're happy to talk to them too. But this is an amazing opportunity to do really good things in the economy in opportunity zones. Back to you.
Excellent. Yeah, and I'm just reminding folks to get really comprehensive on those buildings, to add to that, how to maximize that depreciation. What else can you do to that project, to be comprehensive and add any additional tax benefits? and impact. Jason and others mentioned impact, you know, and that workforce project. You know, put some solar or renewable energy on that project. Get the tax credit from that as well. That's additional benefit that would flow through and enhance that opportunity zone project. Russ, are you doing any of that kind of stuff? And actually, I got a question I'm going to throw to you that's coming in from the audience. Neutral of any tax issues and benefits, which I think need to be considered in this, what type of cash-on-cash returns or just overall returns are you communicating to your investors that they can anticipate?
So what we're targeting for folks is a low teen IRR without consideration for the opportunity zone tax benefits to the investors. So which we think in most analysis, and I'm going to qualify this because I'm not giving tax advice here, but in most analysis, we think that's another, 250, 300 basis points of benefit. Cash on cash varies by deal. Typically, it's in the 6 to 7% range, but there are deals where the cash on cash will be higher. So, for example, on a deal that I referenced where we're not starting ground up construction, we're actually renovating an existing building. Clearly, we'll get to stabilization, full occupancy by residents much sooner, and that will make that yield better. It will make the cash-on-cash return better. I don't know if that fully answers the question, Mike, or not.
Yeah, it does. And Eric, give us a snapshot of the investment return projections for your projects. I know they're probably very different in terms of the timeline and the stabilization for each, but just what are you projecting overall there for those?
Yeah, so we have for both hotel projects actually projecting a 19% IRR, and our cash on cash around 13% on an annual basis. But something important to mention along those lines, and I think you were just talking about tax credits, Mike. And in Puerto Rico, back in 2010, they enacted, it was called Act 74. It's now been amended, but there are tax credits for various industries, tourism being one of them, and you can apply for up to a 40% tax credit of the project cost, including your debt, so including debt financing. And you can take those proceeds over 3 years, sell them at around 85 to 90 cents on the dollar, and they are highly liquid. And so in addition to that, the other part of the act was the incentives where you have a 90% income tax exemption, in addition to a 90% exemption on gains, dividends, distributions, property taxes. So it's pretty beneficial across the board, and that those benefits are qualifiable for a 10-year plus 10-year renewable period. So that allows us. That was definitely one of the decision-making factors when we entered the market here.
Yeah, absolutely. I mean, down there in Puerto Rico, as you mentioned, you get really comprehensive of layering in additional tax benefits into that capital stack. Unbelievable.
Sure.
Michael, how are we doing on time overall?
You're good on time. You're good on time. I made a mistake when I was introducing the panel, so you guys are doing well on time.
Okay, yeah, I heard you mention 2 o'clock, so I wanted to make sure. What is our time frame, so I know how long we have to go?
You have till 2:30.
Okay, excellent. So I'm going to go back to Jason then to follow up on that question in terms of returns and projections. What do you see in there with your projects?
Sure, Michael. And I had a successful raise for our first fund, which was a $50 million capitalization. We're now into Fund 2, which is a $150 million fund, 2 multifamily over retail as well as office. So 4 total assets, low teens IRR at the deal level with a 3x multiple, which on a non-OZ equivalent, it's like getting a 20% IRR or a 6x. And so that's really the power of the legislation. It's about a 400 to 500 basis points impact to returns.
Wow. Lane, how about your projects?
Well, what we're doing is we're looking at the pass-through of depreciation creating much larger after-tax returns. So where we're seeing an IRR of 11% for our fund, the number is over 20% for after-tax. And that's for the person that's investing a capital gain from the sale of a long-term asset. If somebody was to invest capital gain from a short term, they would have higher after-tax returns. If somebody were investing from a 1231 property gain and they offset the 1231 loss to get over 100% tax savings in the year one, then their IRR would be infinity. So it is a factor of when does that depreciation, the operating losses and other tax benefits flow through to the investor. And what we're focused on is maximizing the year 1, 2, and 3 depreciation using the cost segregation bonus depreciation benefits and passing through any operational losses.
And those are great points. And I like the question. It's a fair question, as you know, what's the cash on cash returns that investors realize. But overall, we have to all remember that opportunity zone funds are a tax efficient focused vehicle. That's kind of the whole purpose of them. So you have to look at that in terms of the result. Russ, if you want to give me some update, are you seeing anything in terms of the cost of materials or availability of workers to do any of the projects you're working on? Are you seeing any impact there with COVID?
We are, Mike. It varies by state, by locality. There are a number of states who, during the peak of the shutdown, considered the construction of multifamily housing, especially affordable multifamily housing, to be an essential business, and so construction went on uninterrupted in a number of markets. California is a prime example of that. There are other markets where construction was halted, and because of the local shutdown order. In terms of the availability of trades folks and the availability of materials, we think that as we start to come out of the shutdown and we see more of a return to the workforce across the country, that will generate some savings on construction costs, will generate some savings on materials. And there are a number of reasons for that. Obviously, we've had a shutdown of construction in a lot of areas for the last number of months, so there's been a buildup in supply. There are a number of folks who are now available to work. The single-family home new construction market has completely fallen off, and we think that's going to take a while to get going again.
I hope they're not hearing me. Okay.
And so we think overall, we had some bids on some deals that we revised.
I'm muted. Go ahead.
Correct. You have to be unmuted.
Sorry, can you hear me now?
I'm sorry. Yeah, go ahead, Russ. I was getting some feedback there from somebody.
Yeah, I was too. I'm not sure where we left off, but essentially, yeah, we think there's going to be savings in both labor and materials costs. We saw some of that just as we were coming into the shutdown. We saw some real bids that came in at a lower cost than we had projected. We think coming out of this, because of the shutdown in single-family home construction and the pent-up demand in the workforce, that we'll see some real savings going forward.
Okay, Jason, will you follow up that question that I had? What are you seeing in terms of costs and master planning and operations in response to COVID? What are you seeing out there with your projects? Keep it a bit short and sweet, and then I got some questions coming in from the audience. We'll go through everybody.
Absolutely. We're actually going through master planning process as well, so it's timely. Definitely seeing some downward pressure on costs. I mean, it had been spiraling out of control, as others have noted previous. And in the design review meetings, we're having conversations around how do we actually incorporate changes that residents are going to demand, office workers are going to demand, whether it's UV into the forced air, what type of antiviral surfacing inside of the structures is going to be required. So, it's actually very timely that we're going through that process now, as opposed to having to, double back on time and energy spent previously, because we're, only just getting underway with design and development. So all that's being incorporated now in real time.
Got it. Eric, do you want to follow that up? What's happening in terms of Puerto Rico with COVID and impact to any of your projects?
Yeah, so we were completely shut down. Construction stopped on March 15th. There was a full island-wide shutdown. Aside from that, though, there hasn't been many setbacks significant to just the loss of time. And I think, it's important to point out, I guess it would seem to me at least, that the inherent strategy and intent of OpZone funds is probably less prone to the downside from this than I'd say like a private equity fund with a shorter hold, maybe a 3 to 5 year window, because you experience something like this in one of those funds, it can really throw off your returns. But OpZone funds were structured as long-term investments. Both of our projects are 10-year minimum hold period. And so within that period, likely you'll experience some sort of cyclical downturn. It just so happens it hit us right at the front side of everything. But I think in all, we're pretty optimistic still and kind of getting back to work now. So our construction sites reopened this past Monday.
Got it. Well, good luck with that, and let's keep it moving. And again, I want to come down there, so let me know when you're open and ready to go, and show some folks around. Lane, I'm going to ask I'm going to consolidate 2 online questions. I'm going to give some feedback and ask you for some follow-up on that. But I got a question from a Jay and a Jeffrey that I'm going to combine into one question here. The question is to explain more detail about what the bonus depreciation is that passes with the CARES Act, and do you need to be, and Jay's second half of that question is, do you need to be a qualified real estate investor for tax purposes to be able to utilize the depreciation losses? I'm going to give the first part of that answer. The bonus depreciation actually didn't come out of the CARES Act. It came out before that with Trump's original tax reform and the Tax Cuts and Jobs Act, where they increased bonus depreciation from around 40 or 50%, and it had only applied to new construction of new properties or new renovations and additions to buildings. They added purchases of existing buildings, and again, this applies now for opportunity zone projects. So that bonus depreciation is now 100%. That means 100% of the personal property, like Lane mentioned, identified in the building through a cost seg study. So if you can think of the inside the flooring, the cabinets, the countertops, the woodwork, much of the build out inside is, quote, personal property from a federal tax description. The stuff outside the property are examples of personal property is, landscaping and lighting and signage and parking lots and all those outside site improvements. Those are some examples of bonus depreciation. And Lane, you want to answer the second part of that question? Do you know if you need to be a qualified real estate investor to take advantage of that depreciation?
Well, that is certainly the easiest way, I suppose, to take advantage of it. A real estate professional could be someone that is a contractor or a real estate agent, sometimes the ownership of a short-term rental. You could Airbnb your little basement unit, and typically that would be an investment of 750 hours in a year and 500 hours spent on your own portfolio. But there's other aggregating methods that can qualify, and the key here is to find a way to use the depreciation to go back over time. And right now, the rules for using the depreciation is that you have to have basis. So when you're in an opportunity zone fund, the depreciation, even if it passes through to you, if you don't have basis, you can't use it. So you have to make sure that you have qualified non-recourse financing and that it's appropriate. And I do want to point out that currently the cost of debt for multifamily housing is so low that the advanced rates on loans has increased substantially. And we have certain circumstances where the invested dollar is matched dollar for dollar by depreciation in year one, and then continues to grow each year as the regular 27-year depreciation is passed through. So in those situations, it is like, 100% bonus, in the first year, giving you 100% deduction on your investment. Now in an opportunity zone, that's pretty unusual, but certainly over the course of several years with the construction, that could occur where the bonus exceeds or meets the original investment, and then the qualified non-recourse financing gives the basis. And then with the higher advance rates on debt, namely HUD financing, the 223F loans, there can be a substantial amount of refinancing proceeds that can be passed through, and because of the basis added with the debt, that passes through to increase the returns. And for us, our cash on cash returns are over 20% post-tax. That's pretty significant over a 10-year period of time, So my recommendation is to find a way to qualify, talk to your your tax professional about how to qualify and take advantage of depreciation.
Okay, and another question that I'm seeing online, and I'm going to throw it to each one of you for a quick answer, is what type of investors are you typically looking for or prefer, if there is a preference, and are there maximum and minimum amounts for investments into your projects? I don't always like to call them funds because sometimes they're individual entity projects. Russ, you want to answer that question first? What type of investors are you looking for, and what type of amounts, maximum, minimum?
Sure. So the minimum amount in our funds that are offered through Common Good, our impact investing advisor, is $150,000 per investment. Most of the investments have been well north of that. We are clearly doing something here that we think works economically and has for 20 plus years, and doing something here that also makes a difference in communities. So most of the investors who've been interested in that have those dual purposes. They like to do well and do good at the same time. That we're not limiting ourselves to folks. I mean, we think the economic reasons to invest in workforce housing are so significant, and the demand for the product is so deep and broad, and new construction hasn't and won't keep up with that there are really strong economic reasons to make that investment. And if that works for investors, that's perfect. If they also have an interest in doing something that makes a difference in the community, that has impact in the lives of folks, which is really why the Opportunity Zone program was created anyway, because I think all of the panelists here are doing something similar, then, so much the better. But folks who have a long-term horizon, who can leave their money out there for 10 years to get the full benefit of the Opportunity Zone program, clearly that would be the threshold.
Got it. And Jason, how about your team? Is there an investor preference and amounts that you're looking for?
Sure, and I'll echo, what Russ just mentioned there, just from an impact standpoint. That's certainly one of the drivers of the investors that we're seeing in our ecosystem. We're family office, ultra high net worth. Our fund is structured with $1 million minimums, and we're seeing investors that are also run the gamut into the CRA space. So we've accommodated banks that have been looking for Opportunity Zone investments that also check the box for the commitments they've made, with CRA credits as well. So it's been a diverse range of investors that we've been able to accommodate at both the fund level as well as bespoke investments coming directly into the QASB level, or at the project level, at the real estate.
Mm-hmm. And Eric, how about your projects? Investor preference? Do they have to be U.S. domestic? I mean, I would assume so for a Opportunity Zone application. Investor preference and amounts available for investment?
Yeah, that's right. U.S. U.S. domestic based, and the minimums on our second project that we launched is 100,000 USD. Most of our investors are retail based, some high net worth individual. We're looking for some small private wealth and family office, but we pretty much open to the universe of investors, and we also do co-invest as GP in our projects here.
Okay. And Lane, we're going to wrap it up on time together. What you want to round out that question in terms of your project investor preference, amounts, and you and I talked the other day about optionality. You want to add some final color on that?
Well, I do enjoy talking to people about tax situations and being creative. I've had 30 years in creative real estate transaction structuring, mostly from the finance and tax side. So if someone has a problem, I'd like to talk about it and to see if we can solve it. So 100,000 is typically the minimum, and US based makes sense for the opportunity zone. And if we have projects that are outside the opportunity zone, then that wouldn't necessarily limit to the US base or to the use of the capital gains investments. So anyone's welcome. Give me a little more on the optionality, right, what you're talking about.
Oh, remember we were talking about, everyone gets fixated on that 10-year number and maybe not always wanting to invest in a project for 10 years, get scared off about it. What's the strategy there?
So our fund is set up where the primary sponsor is an investor pari passu with the rest of the investors. So whatever is good for him is good for you. It's not a typical sponsored project. So there's no benefit to us getting out early. So the project can go as long as 27 years. Or if someone wants to get out early, they can sell their share, or they can exit at 10 years to get the opportunity zone benefits. But if someone was to sell early with the approval of the manager, they could then roll over those investments into another project. So we're very creative, and we enjoy assisting people in meeting their needs and their desires to grow their portfolios. And we are looking at the potential 27-year long-term hold, because with the markup of the asset to fair market value, any of the capital gain that is received from the growth in that asset would also be accompanied with the savings on the depreciation recapture. And we're seeing huge multiples, like an 8 multiple or 7 multiple over a period of time. And for a lot of us, we just like to see some good long-term growth and income. So the optionality is to get out early or get out late in this fund.
Excellent. Well, I'll wrap it up. And speaking of options, my suggestion, because I'm non-biased with the group, I mean, if I had an extra couple $100,000 or a couple $1 million or more of cap gain, looking for a great opportunity zone project, I think I would take that and I would spread it around, because it doesn't all have to go into one project. I'd invest some with Eric, some with Lane, some with Jason, some with Russ. And of course, give me a call at Engineered Tax Services. We can look at those tax returns, making sure we're maximizing that cap gain. We're maximizing the depreciation. We're applying that NOL carryback opportunity for additional cash flow. But thanks all for this excellent information. I know that Michael and the team will have our full presentations and background material available on their site for distribution after. There's a bunch more questions that keep coming in, but I think at this point, Michael, I'll leave it up to you whether we should answer those, or are you ready to move on?
We have to move on now. We have another presentation starting. But Mike, thank you so much for doing this. You guys did a fantastic job. It was a great panel. Thank you to all the panelists. And thank you for having you all as members of FLIA. We appreciate that. And we look forward to your continued involvement in the organization and this conversation as it unfolds. We'll be covering opportunity zones in more detail at the next 2 events. So thank you to each of you. If anybody would like to go into the marketplace to check out what we have going on in the marketplace, it is Flyer. It's marketplace.flaia.org. I want to thank all of our members for being a part of our group. This event is sponsored by Off the Chain Capital, Safe Harbor Equity, Entrust Global, Apex One Investment Partners, Millennium Trust Company, and Prequent. Just really want to thank each one of them and for making this possible. Your support, your guidance has been very, very, important during this difficult time. And I also want to bring your attention to our members, the Flyer. They're being projected on the board here, and the staff and our board. Without the guidance and the hard work that comes from putting these together, this wouldn't be able to be possible. It's been a 2-day event, and we're coming up on some of the most exciting parts of the event. Nick Eskandari is up next. He's going to go until 3:00. Nick's the CEO and founder of Keybridge Fund. It's a direct commercial real estate lender located in sunny Beverly Hills with over 25 years of experience serving in various leadership positions. Nick brings a lot of experience in the commercial residential lending, the real estate investment and development, investment banking, corporate finance, capital market space. He's been recognized as one of the most influential leaders by Los Angeles Business Journal. Keybridge Fund sole business is to originate short-term senior loans with maturities ranging from 6 to 24 months with target LTVs of 60% of the property value. So with that, I'm going to welcome Nick